Hi there, I'm Mark Anderson. I'm a mortgage banker with Paramount Bank. Now, Paramount Bank is licensed to lend in all 50 states. This means that I can help you with your mortgage no matter where you are in the country. Give me a call or shoot me a text at the number below anytime, and we will have a conversation to go through your mortgage options in a zero pressure, non-salesy, highly information-driven type process. I'd love to be your mortgage guy. This is the first video in a new series I'm calling the ABCs of the mortgage process. There are a ton of what I'm going to call $10 words floating around my industry. These are words that make it very difficult, I think, for the average consumer to find good information about the mortgage process. And we're going to start at the front end of the mortgage glossary of terms at the letter A with a word that I find very difficult to pronounce: amortization. Amortization, amortization, amortization. That's how a lot of people say it. Amortization, just kind of shoved together. Anyway, however you pronounce it, and however I pronounce it in various ways throughout this video, amortization is actually a very simple concept. So the etymology of this word, if we look at the root languages and some of the words that have been manipulated over time and turned into this English word amortization, it comes from some very old French and some vulgar Latin, which I actually have to tell you, I am not an etymologist or a student of etymology, but my understanding at a root level, the word comes from to die, to kill. And in this case, what we are killing when we amortize a loan is we're getting rid of the principal balance. To amortize a mortgage loan is simply to pay it off over time. To amortize a loan over a set amount of time involves a specific term or length of the mortgage contract. The most common term for a mortgage is 30 years. A 30-year fixed rate loan is one that amortizes, i.e. pays off, over 30 years or 360 months. You could also do a 15-year loan or 180-month loan. Really, any whole year increment, you can get a mortgage that amortizes over that amount of time. Now, one of the benefits of amortizing your loan over a shorter period of time is that you're going to pay less interest because you are going to be paying interest for fewer years. This is overall a fairly simple concept. Where amortization gets really interesting is when we look at the math involved. And where I'm going to start with that to illustrate the concepts behind this is we're going to use a very simplified version of an amortization table. Now, the main thing that I have done to simplify this math is I have eliminated the interest rate. If you were to borrow $400,000 and pay that over a 30-year or 360-month period, the amortization schedule is very easy to generate. In fact, this is math that you can do with a calculator. We are going to amortize this loan at 0% interest over 360 months. So that's just 400,000 divided by 360 from my Sky calculator, and we get a total of $1,111.11 per month. That almost certainly is not in focus. What makes amortization complicated is the presence of interest. However, the math for amortization is actually fairly simple. What I'm going to walk you through now is this very simple, easy to understand mathematical formula. Okay, don't worry, we're not actually going to solve this formula because it turns out we have something better than a calculator. We have computers that have spreadsheet software. And in that spreadsheet software, you can very easily run your own amortization tables or schedules, whatever word you want to use. Before going into these examples, I do need to make it clear that the interest rates used are purely for illustrative purposes. These are not intended in any way to be considered a mortgage quote. Now, what we see on this amortization table is the entire future of a mortgage loan. There is a breakdown over the entire 360-month payment schedule of the amount of principal that is paid on each payment and the amount of interest that's paid with each payment. What you'll notice right off the bat is in the beginning, the amount that goes toward principal is relatively small. The the amount toward interest is relatively high. Now, I hear a lot of people complain about this. They say, oh my gosh, it's criminal. I'm paying all of this interest on the front end of my loan. But really the reason for that is at the beginning of a loan, you actually owe more money. And the interest rate, which is technically speaking an annual rate, has a greater amount of money to apply that rate to. What the amortization formula is doing behind the scenes is it is determining the spread up front and the spread over time of how much principal needs to be paid with each payment and how much interest needs to be paid with each payment to eventually, over the entire term of the loan, to eventually get to a zero balance. Now here's where things get cool. We can actually compare the overall cost of financing over a long period of time, and what we're going to do here is compare a 30-year loan to a 15-year loan. Now in the real world, it is very likely that you will get a better interest rate on a 15-year fixed mortgage. But just to illustrate the key concepts involved in the amortization and how a shorter term schedule reduces the amount of interest you spend over time, I've actually made the interest rates the same in both of these cases. As you can see, the 30-year total interest paid over the entire 30 years versus how much you pay in interest over 15, the difference is shocking. What I think is really powerful about the amortization calculator is the ability to see the true cost of financing over time for all kinds of cases. It is so important to go beyond just focusing on the monthly payment itself. Now, these are just a couple of the things that you can do with these amortization schedule calculators. And what I would like to do is offer you the chance to run your own calculations for your own scenarios by using the exact same tool that I use. Just send me a text. Give me your email address, let me know that you would like this tool, and I'll go ahead and email it over to you as soon as I can. Now, what I'm going to promise you is that I'm not going to take your email and put that into some sort of spammy auto email campaign. That's not really my style. That said, if you find the tool useful, I would really appreciate it if you would like the video, subscribe to my channel. If you're really kicking around some mortgage options and you would like my opinion, if I have a shot at earning your business, give me a call, shoot me a text, and let's talk through it. You don't have to do the heavy lifting with these numbers on your own. You can let me do it for you. And while we're at it, if you have any mortgage-related questions, throw those in the comments below and I will get back to you. I hope that you found this video useful. I'm really looking forward to going through the entire glossary of mortgage terms and sharing what I know. Thank you so much for watching, and I hope to talk to you again soon.